Welcome to Kitco News. I'm Niels Christensen. We're here at PDAC 2020. Joining me today to talk about the market volatility is Adrian Day, CEO of Adrian Day Asset Management. Welcome to the show.
Well, thank you for having me, Neil. Good to see you.
It's fantastic to talk because lots to talk about. Let's get right to it. Fed came out with a 50 basis point cut. What do you think we should expect?
Is it more for gold? Yeah, I definitely think there's more upside for gold. Just to focus on the Fed for a second. I mean, this is really a panicky move. The Fed has already said, a rate cut can't fight a virus. So having a rate cut, especially a 50-point rate cut between markets, between meetings, just because the market had a hissy fit and demands it, is really a panicky move. And I think the reaction in the Dow is telling us this. Participants see this not as a rational move, but as a panicky move, and that's negative.
And we saw it, but we also saw it in 2008. I mean, this is the sharpest cut since 2008, yep. and it was seen as a panicky move when Bernanke did it in 2008.
Yeah. Well, and part of the problem is everybody knows this is not the last rate cut. See, the whole point of cutting rates as a stimulus, it's only a stimulus if you cut rates and people say, wow, look at these wonderful low rates, let me go buy a car, let me refinance my house, let me borrow some money to do something. It's only a stimulus if people react to it. But if people say, you know what, wait another 3 months and they'll cut again, and by the end of a year, they may cut 3 more times, there's no incentive to do anything now. I think the Fed has completely boxed themselves into a corner by keeping rates too low for too long, and now it has no impact.
So what do you think we can expect for gold price? I mean, what does this mean? And if Fed rate cuts have no impact, is it now fiscal? And what does gold do with fiscal stimulus?
Whoa, that's a huge question. Well, just on the first one first, and then don't let me forget the second one. I mean, on the second one first, but don't let me forget the first one. Yeah, I mean, the central bank, both in this country, but more especially in Europe, has been calling for the fiscal authorities to play their part, which basically means the government should spend more money without borrowing about little things like deficits. That's what play their part means, and the central bank is saying, we will print as much money as you guys want to spend. That is basically modern monetary theory, or as I call it, modern magical twaddle. And it is extremely bullish for gold, because it means, apart from the huge increase in spending, it means higher inflation, finally. There were good reasons why we didn't see inflation with the massive injections of money from 2008 until now. Or really the last year we've started to see inflation pick up. But there were good reasons. We don't have time to go into them. But this changes it. This changes that dynamic and we will get inflation. I think it's incredibly bullish for gold. When the Fed was cutting rates and the banks were simply taking that money, printing money, and the banks were taking that money and putting it back on deposit with the Fed, and the Fed was paying interest on excess reserves, then none of that money was getting into the real economy, and it was not bullish for gold, or particularly bullish for gold. When the Fed said we are going to start tightening in 2014, and finally they raised rates a couple of times and then backed away, that was the Fed surrendering. That was the trigger for gold to go up. So the Fed now, it's not surprising that a 50-point rate cut today is bullish for gold, and the fiscal authorities playing their part, sounds so nice and benign, doesn't it? Will be very bullish for gold.
So we're here at the world's largest mining conference. I want to ask, with all of this volatility that we are seeing in equities, do mining stocks look good? One of the things I've heard is that mining stocks really need a bullish equity market. So I'm sort of wondering, what do you like? Do you like mining equities or golds?
Another huge question. Gold mining stocks will tend to do better when gold is up and the broad stock market is up. But gold stocks don't it's not a necessary condition for gold stocks to go up to have a good gold market, because there is such a thing as rotation, where people will rotate out of high-flying tech stocks or high-flying social media stocks and rotate into things that have underperformed or are cheap. Now, if you have a market crash, particularly one caused by liquidity, then the gold stocks don't do well. That's an uphill battle. In this kind of environment, I would say to people, absolutely start with bullion. Have the bullion as your base, as your insurance, with no question. But you know, the gold stocks, both the seniors and the juniors, are, as you know, pretty much at all-time lows relative to gold bullion. They are incredibly undervalued relative to bullion. And so I think that there are some great buys among seniors and juniors right now.
Especially now with a lot of seniors offering dividends in this low-yield world.
Yeah. Well, can I argue with you on that?
Go ahead.
You know, mining is a capital-intensive business. Miners are always going to want capital. Even if they're not building a new mine, they need capital for ongoing expansion, ongoing capital. Personally, I think it's a mistake for mining companies who require capital to pay out dividends. It's a mistake to pay out dividends and then 6 months later turn around and raise equity because they need capital. So, and let's face it, who in the world buys Newmont because they're paying 1.25%? Who buys Yamana because they've now increased their dividend by 50% or whatever? Nobody. It's a meaningless thing. So I think they should preserve the capital for capital expansion. In my view, the only companies in this space that should pay dividends would be the companies that have sustainable ongoing cash flow. So that means royalty companies, royalty and streaming companies, or if you have a single mine company that has no intention of expanding, like the old South African miners, for example. There are few of those around. But if you have something like that, yes, pay out your cash flow. But other than that, I think they should preserve the capital.
Okay, so finally, bullish on gold. Everybody should be, have a base in gold. Where do you see the price at the end of the year, if I can ask you that?
Oh, Lordy, that's so difficult because so much depends. And the truth is, for coronavirus, I'm not expert on that. I have no particular anything I say on that. You take with a grain of salt. But that is a big factor that will help focus on the price of gold. I'm looking at something around 1750, the mid 1700s. So a nice move from here.
Excellent. Thank you very much for sharing your thoughts on the gold market in this extraordinary time.
Yeah. Well, thank you very much for having me.
Thank you very much for watching Kitco News. For all our coverage at PDAC 2020 and all the latest news in the precious metals market, go to our website at kitco.com.